Hello, this is Bruce One, Head of Research for MaxCap Group. In this video, I want to go on a journey of exploration through the private credit markets to get an understanding of its various segments, especially to see how commercial real estate debt fits into the broader picture. We can do this by addressing a couple of questions. What is private credit? What is the fuss all about? How should we select strategies? And how is this uncertain market environment affecting the outlook? Most people start with the first question, what is private credit? The answer is mostly in the name. It is the provision of credit or debt capital for borrowers to acquire assets. It is done in private markets outside of public exchanges. This segment is getting a lot more attention and new capital in recent years as investors look urgently for more consistent and more diversified returns in a world where consistency and diversification are getting harder to find. For a number of years, private credit has been sitting nicely at the intersection of two major trends, the shifts from public to private markets and from equity to debt. So we're seeing a lot of capital chasing strategies within the space. Certainly the world of private credit comes in many different flavors for investors. Private credit capital may be used to buy homes as residential mortgages, to buy offices, warehouses and malls as commercial mortgages, to run a business as corporate lending, or to develop real assets as construction finance. Across these different segments, you will see some variations in yields and spreads or the income payable to investors above the risk-free rate, and also in terms of duration or the length of the loan. For what we do, commercial real estate debt, yield spreads may sit at around 5% over cash for first mortgages and 8% over cash for junior loans. Duration tends to be actually quite short as these loans roll over every 2 to 3 years. In the context of a volatile global marketplace, it is a good time to consider the outlook for the sector. Looking at this chart, we can see the historical returns in private credit, specifically first mortgages in commercial real estate, compared to a range of public credit benchmarks, including sovereign and corporate bonds in Australia and markets abroad. For a long number of years, commercial real estate debt returns have been very resilient, even during global recessions, pandemic lockdowns, and big swings in cash interest rates. This stability is not something we have seen in other asset classes, including public credit markets. Altogether, we continue to see good opportunity in Australian private credit over the next few years, particularly in commercial real estate debt. We expect this segment to draw in more investors looking for firm and stable returns, especially in the face of more volatility in stock and bond markets. Now, if you want to talk to someone about the potential opportunities in this space, feel free to reach out to our capital team for a chat. This has been Bruce One from MaxCap Group.